Hello friends and subscribers, welcome back to Readings in Impact Investing. My name is Daniel Rosehill and this is a podcast which I have set up in order to read important material in the world of impact investing. This podcast is currently available on YouTube. We were also available on a podcast hosted by Spotify for podcasters, but I'm having very strange login issues, technical problems. So for the moment, it's actually not going to be available as a podcast. At some point in the future, I might get around if maybe it'll work again, or maybe I'll be able to move to a different podcast hosting platform. It's an extremely strange issue that I haven't seen. I'm just not able to log in, and the forget password prompt doesn't seem to be reaching me. So for the moment, we'll just do YouTube. Just to restate the introduction, my name is Daniel Rosehill. I work in the field of impact investing, and I like to read stuff on audio format. So we're going to be looking at today, after concluding the Impact Taskforce 2023 report in its entirety. That was called a State of Play, and that was their second report after their inception in 2021. I'm going to be reading through one of the input papers from the Global Steering Group, better known as the GSG. This one's called Time to Accelerate Capital Mobilisation for the SDGs in Emerging Markets, a progress report in the last 2 years of capital mobilisation for the SDGs. So for those who need a reminder, there are two work streams in the Impact Taskforce, and this is work stream B, which does capital mobilisation into the so-called EMDEs, which stands for Emerging Markets and Developing Economies. So what I'm going to be reading in this first reading or episode is the exact summary and the introduction. Together, that's going to be about 3 pages, and that'll then prime us nicely to get into chapter 1 in the next episode, meeting the SDGs and achieving a just transition. The target is moving further away. So without further ado, let's go with the exact summary. The SDG and just transition financing gap has increased, and capital is still failing to go where it is needed at the volumes required. The COVID-19 pandemic has widened the financing gap to meet the SDGs, with the world also off target to meet the 1.5 degrees Celsius temperature increase goal laid out by the 2015 Paris Agreement. An estimated $40 to $60 trillion is needed over the next 5 years alone to address pressing environmental and social challenges. Climate finance broke through the $1 trillion mark in 2022, but remained a fraction of fossil fuel subsidies that still amount to $7 trillion. Very interesting fact. As economies contend with inflation and the impact of conflict in Ukraine on energy supply. Renewed market volatility and rising interest rates have put pressure on investor appetite for EMDE assets, meaning that international investment is failing to reach the geographies that require it the most. Only 13% of global climate finance is going to EMDEs, and private finance to EMDEs, excluding China, is estimated to have actually declined 22% from 2021 to 2022. Governments and institutional investors have acknowledged the importance of a just transition to net zero. However, initiatives have yet to deliver on promises and have largely failed to integrate social considerations, i.e. the ways in which climate change will affect jobs, access to water, food and other resources, human security and livelihoods, into environmental and climate targets. DFI and MDB mandates and investment practices are evolving. However, they have been slow to mobilize private capital through appropriate investment opportunities. In 2021, their efforts only mobilized $40 billion of private investment into EMDEs, down from prior years. With less than $1 of private capital mobilized for every dollar invested by DFIs and MDBs, these institutions are under increasing pressure from the G7, G20, EMDE policymakers, think tanks and other actors to mobilize significantly more private capital to deliver higher development impact. DFIs and MDBs remain the best placed organizations to mobilize private capital and have the tools at their disposal, but must undergo a mandate change to meet their potential. And just to de-acronymize this, DFI is a development finance institute and an MDB is a multilateral development bank. DFIs and MDBs remain the best placed organizations to mobilize private capital and have the tools at their disposal, but they must undergo a mandate change to meet their potential. Sorry, I read that already. DFIs and MDBs need to rethink their traditional origin to hold strategy and take higher levels of financial risk. In doing so, they can generate more investment opportunities for institutional investors. Larger DFIs and MDBs can also select and bundle pools of assets, which can be sold or securitized to free up their balance sheets for further investment. Increased use of blended financing guarantees that shield institutional investors from losses can de-risk investments and encourage the flows of private capital into EMD opportunities. At the same time, better understanding and mitigating of currency risk, as well as better access to performance data, can help investors to address real and perceived risks, especially when it comes to investments in EMDEs. Only 18% of financial instruments in DFI and MDB portfolios have private capital mobilization as a main objective, meaning that mandates must be reformed to incentivize and drive private capital participation. Efforts are underway at both the G7 and G20 level, but they must be accelerated to address the urgency of unlocking investment for the SDGs, of which only 12% are on track. Focus and support need to be directed to domestic EMDE initiatives, delivering locally relevant solutions for SDG investments and offering opportunities at scale to unlock further institutional capital. EMDE pensions are growing rapidly and are among the highest priority routes to unlock private capital for domestic investment. Local players have a stronger understanding of their domestic markets and invest in local currency, which is often more secure for recipients of investment. Public development banks hold over $23 in assets but need to work more closely with investors to promote opportunities that support the SDGs and just transition. Their local knowledge and relationships can act as a catalyst to encourage and mobilize domestic and international private capital investment. EMDE impact fund managers and funds of funds are critical to direct capital where it needs to go. Such funds can address investor challenges around scale and access to a pipeline of opportunities in critical small and growing businesses. Domestically led initiatives such as those led by the GSG affiliated National Advisory Boards or NABs in Ghana, Nigeria or Zambia are a great example of collaborative efforts, connecting public and private finance with the demand side, solving for the multiple issues around SDG finance and EMDEs at once. It is time to structure new catalytic capital facilities. Echoing calls to action in the ITF Annual Report 2023, we encourage new facilities to be set up to invest for high impact in priority areas, such as facilitating access to appropriate capital for job creating micro, small and medium-sized enterprises, the MSMEs. Recommendations: MDBs, DFIs, investors and catalytic capital providers, the recommendation is to them, support, collaborate with and invest in financing structures and initiatives led and developed by domestic stakeholders in EMDEs aimed at improving access to finance for SMEs and the achievement of the SDGs. Specifically, increase the supply of catalytic capital in EMDEs with the view of creating regional catalytic capital facilities that would boost such domestic solutions. MDBs, DFIs and their shareholders, material reform of DFIs and MDBs, ensuring clear capital mobilization strategies with ambitious targets, moving them from less than 1x to multiplied mobilization ratios that will allow greater impact to be achieved within the next 5 years, and transparency and accountability enshrined in their mandates. MDBs, DFIs and catalytic capital providers, systematic and more efficient use of de-risking mechanisms, including the scaling up of existing successful facilities to leverage private capital investment and increase the number, size and quality of investable opportunities aligned with the SDGs in EMDEs. MDBs, DFIs and catalytic private capital providers unlock data and evidence about financial and impact performance and investments in EMDEs. Specifically, DFIs and MDBs should keep to the proposed timeline of making the GEMS database, that's GEMS, available to third parties by early 2024, allowing investors to make better informed investment decisions. Introduction. There will never be enough public money to achieve the UN Sustainable Development Goals and ensure a just transition. That was a starting point for the Impact Taskforce work 2 years ago, and it is as true today as it was then. In contrast, upwards of $230 trillion is traded annually in the capital markets, and institutional investor appetite to deploy capital into investments with environmental, social, and governance and impact objectives is growing. The inescapable conclusion is that only private capital, often layered with public or philanthropic capital, has the capacity to support projects and initiatives that will drive the world towards net zero while also ensuring that nobody is left behind. ITF 2021 Workstream B posed the following question: how can we accelerate the volume and effectiveness of private capital seeking to have a positive social and environmental impact in emerging markets and developing economies? The answer focused on the creation of clearly defined investment opportunities within institutional structures that meet investors' fiduciary requirements. It highlighted multilateral development banks or MDBs, development finance institutions or DFIs, and institutional investors as key actors with the potential to bridge the aspirations of policymakers with the needs of vulnerable communities and a dramatically changing planet. It also spotlighted emerging markets and developing economies, the EMDEs, where investments are often smaller, markets are less liquid, and hence perceived as more challenging territory for institutional investors to invest in. 2 years on, findings show the volume of private capital being mobilized is insufficient to address today's environmental and social challenges, and that its trajectory falls far short of what is needed to meet the SDGs and global climate goals. Moreover, EMDEs continue to lag behind in allocated capital to finance the SDGs, leaving the very populations most at risk of climate change with few resources to combat it. So now the question more pointedly becomes, how can we realise the full potential of DFIs and MDBs to mobilise private investments for positive impact on the SDGs and a just transition in EMDEs? Our new report examines the role of DFIs and MDBs in mobilising private capital and how changing their mandate and allowing them to take on more risk can stimulate and facilitate more private investment. Critical as they are, these finance institutions are not the only part of the puzzle. Domestic EMDE capital sources such as pension funds and public development banks with national financing agendas are among the best placed to support SMEs that are the lifeblood of their economies and have a central role to play in delivering the SDGs and a just transition. This report examines the evolution of the financing challenges facing the world and the role of key actors in mobilizing private capital in EMDEs. It provides recommendations for accelerating impact where it is needed most. The good news is that most of the structures and tools needed to mobilize private capital at scale already exist. Moreover, many are already in use, with private investors increasingly shifting allocation strategies towards achieving sustainability and impact outcomes. Better apportioning and understanding of risk can help break down the barriers that are holding back investment in EMDEs. Just as better use of resources at a domestic level can unlock the capital that can support homegrown companies well positioned to support a just transition and the achievement of the SDGs. The time for discussion and debate has long passed, and the time for urgent action at scale is now. So that brings to a conclusion the executive summary and the introduction of this report. And in the next episode /podcast /video, we're going to be continuing on to chapter 1, which is called Meeting the SDGs and Achieving a Just Transition. The target is moving further away. That reading coming up next. If you're working in the field of impact investment and you know of other colleagues or just people you know who you think would like to receive these reports in audio format, please do pass on the YouTube channel and give it a recommendation. And if you have reports that you think are timely, incisive and worth reading, feel free to drop me an email. My email address is public, PUBLIC, at DanielRosehill, ROSEHILL.com. Thanks for listening and have a wonderful day.